Everyone, thanks for being on today's session. I wanted to welcome everybody to the most recent edition of CleanEdge's Clean Tech Nation Briefing Series. I'm Bryce Yonker. I'm the Director of Business Development here at CleanEdge, and we're excited to have about 400 folks registered for this morning's session. Ron Pernick, our Managing Director, will be moderating today's conversation, and I'll be handing it over to him in just a quick minute. But wanted to cover a couple quick housekeeping notes. First, if you're already on the webinar, you'll know you're successfully in. I'm glad you're there. If you dialed in and you may be having any issues with the login, we noticed that we had to download another version of the GoToMeeting platform. So go ahead and try it again, and I'm sure you'll find your way in successfully. You can send me an email, yonker@cleanedge.com, if you're having any issues, and maybe we can try to troubleshoot something. Another note, we're going to have a very interactive session this morning, so if you have questions, please enter those into the question field on the GoToMeeting system. I'll be moderating those, keeping an eye out for them, and sending them over to Ron so they can be covered during the session today. So again, if you have questions, please feel free to ask them, and we will include as many as we can in today's discussion. So everybody here is in listen-only mode, so that question box is the way that we will make it as interactive as possible. I'm going to hand it over now to Ron Pernick. He's our Managing Director, and he will kick our session off. So thanks, everybody, for being here.
Thanks, Bryce, and I want to welcome everyone to today's webinar on natural gas and renewables, finding synergies for growth. We're grateful to have three well-informed and very articulate panelists to help us better understand the current electricity marketplace in the U.S., and where things are headed in particular with a real abundance right now in the U.S. Around both natural gas and renewables. We're going to really look to explore the regulatory, economic, environmental, and policy drivers behind this intersection of renewables and natural gas. With us today, we've got technology and policy expert Doug Arent from the National Renewable Energy Laboratory. Doug, thank you for being here. We have investment expert Michael Butler from Cascadia Capital, and we have Don Furman, former SVP at Iberdrola Renewables and chairman of the Wind Energy Foundation. So welcome to all of you. Just a quick overview of how today's webinar will work. We try to keep these very lively and interactive. So after I set the stage, we'll launch into a moderated conversation with our panelists. And then, as Bryce said, we're going to open up to questions from the audience. So please be sure to type your questions into that chat dialog box, and we'll do our best to cover as many queries as possible. We usually get quite a few, a couple dozen questions. So thank you. Before we begin, I'd like to thank our co-host of this series and today's webinar, Cascadia Capital. Cascadia Capital is a national investment firm based in Seattle, and they have a strong and committed sustainable industries practice helping to structure prominent deals throughout the clean tech value chain, and as well as Michael will tell you, within natural gas. Let me set the stage here a little bit, a little background. I mean, it's really quite astounding. If you look at this slide, we issued last week our Clean Energy Trends 2013 report, our 12th annual edition of that report. And this slide, I think, really helps set the stage for today's conversation, as it shows the story of renewable electricity capacity in the U.S. has really largely been one of natural gas and renewables in recent years. So if you look here over the past 4 years, these two sources alone contributed more than 80% of all new energy capacity additions or electricity capacity additions in 2009, 2011, and 2012. In a lower year, in 2010, natural gas and renewables combined still represented around 65%. We have a great quote up on this sheet. As Michael Mayor Bloomberg said at the ARPA-E event just outside D.C. where I was at, and some of you were probably there as well, he said, in the U.S., coal is a dead man walking. And it's not just capacity additions, but generation. 9 states now get more than 8% of their in-state electricity generation from wind power alone, and 2 states, Iowa and South Dakota, now generate around 20% of in-state electricity from renewables. Also, just a quick look at the headlines from the past month show how major investors such as Mid-American, Energy Holdings, Warren Buffett's group, and Google are upping the ante with large-scale investments. In fact, MidAmerican's recent acquisition of the world's largest planned solar farm will leave that mainstream energy player with 6% of U.S. wind and 14% of U.S. solar holdings. That's clearly a moving target, but it gives you an idea of where they are today. And it's not just new coal, but existing U.S. coal plants that are being replaced with newer, less polluting, lower carbon options. And from a pure economic perspective, it's becoming clearer and clearer that nuclear is finding it increasingly hard to compete against other options, in particular wind and natural gas. So with that high-level staging, stage setting, I'd now like to launch into a dialogue. And the first person I'd like to address is Doug. So Doug, you've been involved in researching and publishing reports, really tracking both renewables and natural gas and the integration of those sources. As you know, as we all know within the environmental community, not surprisingly, there's been growing skepticism of the role of natural gas, with particular concern around fracking and methane leakage and more. On the gas side, I feel there's often a seeming disregard for any other option than their own. So in your view, can you tell us a little bit more about why there is room for renewables and natural gas in the U.S., and as we framed in the title of this webinar, how these two energy sectors can find common ground? And so I'll hand it over to you, Doug.
Yeah, thanks, Ron, very much. Hopefully you can hear me fine.
You sound great.
Good. Yeah, appreciate the question. Yeah, we have done a significant amount of work looking at the renewables and natural gas and the synergies between them. And in particular, it really comes across in a couple of different specific ways. First off, there's technology synergies. So one can look at, for example, how the power system operates, the delivery of services to the system itself. And then secondly, there's a much stronger opportunity for financial synergies when one looks at this, either from the investor standpoint, but we'll hear from our other panelists on that front, but in particular from a broader set of stakeholders. So when one thinks about from a utility, from a consumer advocate, from a public utility commissioner who's overseeing a lot of the regulated markets, in that sense you see significant benefits from a portfolio perspective. When you look at risk management across the landscape between capital exposure, fuel price exposure, and long-term fixed price contracts and what they bring into a portfolio as well. It's also very regionally dependent. So one can see that in some markets, gas continues to be very low priced, but in other markets, primarily due to structural and delivery constraints, gas can be, even today, very volatile, and therefore has a complement to long-term fixed price contracts from renewables that don't have that price volatility. There's also a perspective when one thinks about medium to long-term synergies going forward. So when one looks toward longer-term decarbonization, for example, particularly in those states which have high RPS standards, and or in scenarios that we've evaluated, for example, in the Renewable Electricity Future Study, you see a very strong synergy between gas and renewables going toward deeper and deeper decarbonization of the power sector. So strategically, we see it very strong going forward, and there are, of course, concerns that you've mentioned on the gas side, but maybe we can address those later after we've walked through a couple of the other questions.
Yeah, we'll definitely come back to some of those issues and talk about the risk management as well. Let's move over real quickly to Michael, and then we'll go through each of these, and then we'll kind of come back to other questions. Michael, you've been at the forefront of clean tech investing. You've helped structure, broker, finance deals for nearly a decade in the clean tech space and elsewhere. But as you know, that there's been increasing pressure on the clean tech landscape, and you and I have talked about this quite extensively. And at the same time, I know, while there have been those sort of pressures, you've been ramping up a lot of your natural gas activities. So looking out the next few years, do you see natural gas taking most of the energy investment limelight, or will clean tech continue to garner interest, activity, and funds? Let me hand that over to you, Michael.
Sure. I think, first of all, you have to delineate between renewable energy and clean tech. We have seen capital leave the renewable energy sector. Renewable energy.
Hey, Michael, I don't know if anyone else is. I'm not hearing you very well. Can you confirm once again that you just have your telephone button selected?
Yep. And only have my telephone button. Correct. Can you hear me now?
Okay, let's keep trying and see what we're able to hear. I know you're breaking up for me, but let's try it one more time.
Okay. Can you hear me now?
Yes.
Okay. So I think we have to delineate between the renewable energy sector and the clean tech sector. We are seeing capital leave the renewable energy sector, solar, wind, biomass, etc. Capital is still coming into the clean tech sector, which is technology for smart grid and energy efficiency and storage. So I think you have to delineate between clean tech and renewable energy. We have seen a lot of the capital that heretofore had gone into renewable energy go into natural gas. And initially that capital went into the supply side, exploration and production. What we have seen in the past year is that capital that had left renewable energy went into the supply side of natural gas, now migrating to the demand side of natural gas. So, for example, building out infrastructure that allows industrial users to convert from diesel to compressed natural gas or liquid natural gas. Conversion technologies that convert fleet vehicles from gasoline to CNG. And now what we're starting to see is some interest in the combination of renewables and natural gas, right? Using the natural gas plants to smooth out the ebbs and flows of renewable energy for power providers. So I think we're seeing the capital moving from renewable energy to then the supply side of natural gas to the demand side. And I think in the next 12 to 24 months, you'll start seeing more capital go into the combination of natural gas and renewable energy for power providers.
Great, and we're going to get into that a little bit more and maybe talk about some of the actual ways that folks are doing that, because I think that's going to be a key part of today's conversation. Thank you, Michael. I'm going to move over to Don. You know, kind of playing off of that, you have a wealth of project experience. You've done both renewables and fossil fuels, having been at Iberdrola, I believe one of the largest renewable energy asset holders in the world, as well as Pacificor. I think all of us on the panel agree that the future of our energy systems will be diverse and really won't be a zero-sum game or, you know, in any way a winner-takes-all scenario. That's kind of what we're talking about here. So from a project and operational perspective, how do you see natural gas and renewables reinforcing each other, as our other panelists have just talked about, instead of just competing against each other?
Well, thanks, Ron, and thanks, everybody, for joining. First of all, I think you have to admit up front that they do compete with each other. You know, we have a fairly competitive landscape when it comes to providing, you know, the next tranche of generation. And so lots of developers out there, lots of utilities who have, particularly in the last 5-10 years, really gotten back into the development game themselves when you think about Mid-America and other similar companies. So there is a competitive aspect to that, and I don't think that's going to go away. But what's interesting is and it's been alluded to, how they do complement each other. And I want to be clear about this. It's not so much at the project level that they complement each other. I mean, there are some companies that have experimented with co-siting renewables and natural gas, or co-siting renewables with storage. And in my experience, that's hard. It's tough to find exactly the right intersection of components. But also, if you think about it, the place where the integration and the portfolio benefits happen is at the system level. It's at the operator level. And for the last, I don't know, if you go back 5 years, the issue at the operator level was all about integration. It was all about, oh my gosh, we've got these variable wind and solar resources. They're all over the place. We've never looked at weather. We've looked at weather reports in terms of demand and trying to estimate where our demand is coming from. We've never had to do it in terms of generation, to estimate what our generation is going to be the last hour. So the focus has all been on giving the guys who sit on the desks in the control rooms the tools to manage that stuff. Well, now they've got it. And the interesting, the interesting thing that is evolving is the debate is shifting from the real-time operations to more of the planning function at the utilities. And there's an opportunity to optimize. And the optimization comes from a couple of sources. And what I'm talking about optimizing between renewables and conventional generation, and in particular natural gas. We all thought that hydro was going to be the ultimate resource to integrate variable generation. And in fact, it turned out not so much. We had the oversupply situation in the Northwest where there was no place to put the water. Well, there's also economic issues in terms of the opportunity cost that you lose with hydro as a similar fuelless resource. Actually, gas turns out to be a much better resource, in my opinion, to integrate renewables. And so when you think about the benefits that you can garner from putting together a complementary portfolio of the two, you have the hedge benefit that's already been talked about, and I'm sure we'll talk about some more. Lawrence Berkeley did a paper recently on that, and NREL has done some very good work on this, on the long-term hedge value, which you really can't get someplace else. A long-term PPA gives the utilities exactly what they need, which is the ability to put either a long-term contract into their rates or an asset in the rate base. And it's sort of like, Ron Popeil on late-night television with the Showtime rotisserie. You set it and forget it, which is a good thing for utilities because they don't get paid to take risk. So I think and hopefully we'll get into this some more, but I think the really interesting aspect of this is when we go forward on a planning basis as a utility in particular, how do you capture that diversity benefit, and how do you capture and optimize the flexibility of gas with the price suppression aspects of renewables?
Well, thank you, Don. So let's now jump into some questions. I think this whole point that you make about that hydro didn't end up being quite the great pairing with other renewables as we had hoped for, and that natural gas, in fact, is a perfect complement. And we've sort of talked about that a little bit. One of the issues is that some of the older plants just don't power up and down that quickly. And I know GE and some other firms are now doing next generation power plants that can really are built and optimized for pairing up with renewables, not surprising for GE since they have interests on both sides. I'm just wondering, maybe we could start with you, Doug. How important is this breakthrough to the integration of nat gas and renewables, these new power plants? And are you tracking interesting developments in the field where people are sort of pushing the envelope a bit on those types of integrations? And then we'll go to the others.
Yeah, thanks, Ron. We are tracking quite carefully and work with GE on both sides of that equation. The innovation here, I think, is really quite transformative, particularly for those situations and systems where there's increasing amounts of renewables, i.e. on the higher end of the system. It's not absolutely critical, when renewables are just emerging into the system at relatively low penetrations. But there's also additional complements in terms of what's going on the technology front, which is not just on the generation front, but it's really the utility's ability to manage demand. So a lot of innovation in the quote-unquote smart grid space, virtual demand loads and demand management activities, et cetera, as well as increased, as mentioned before, ability to use advanced forecasting so that there's better predictability of the generation that's coming out of the variable supply. So across all those fronts, you see a significant amount of both technology but also business case innovation that enables greater and greater integration with less challenges, let's say, of greater amounts of renewables.
Great. And Don, what are you tracking there? And sort of obviously there's the new gas plants and all these other technologies, but sort of how are you seeing utilities sort of better manage that? And if you could talk a little bit about it, that'd be great.
Sure. I think in some ways it was very unfair to foist all of this variable generation on to a workforce that hadn't been prepared for it. And as I said, about 5 years ago, it was sort of shock and awe at the utility operational level as they, I recall the event, the so-called event in July of about 5 years ago in Texas, where the operators, in retrospect, could have seen a big event coming in terms of wind and didn't catch it, and it created a system issue. I think what I've seen is a tremendous amount of development of skills and tools in the operating room that allow these guys. I mean, look, operating a utility system is hard. I mean, it's really hard and it's stressful. It's like being an air traffic control person. And with the right tools and with the right training and forecasting capability and flexibility, part of the tools is having the flexibility. And Doug just made reference to some of the opportunities on the smart grid front. You're starting to see these things penetrate the control room, and you're starting to see utility operators have a much better time of integrating renewables. Most of them at some point will say, I sure wish I had a little bit more gas on the system. I mean, again, it's regional, as Doug said, but and so you sort of go with that. It seems like that is the way to go, is to look at the two resources, renewables and gas, together. And I think we've probably only scratched the surface of really understanding the benefits of that. Sure, there's a long-term hedge. There's also a big price suppression impact that is just starting to be studied, and I think will lead to some pretty substantial consumer benefits that can be quantified.
Great. And Michael, do you have anything to add to that before we go on to the next question?
No, I think that sums it up, particularly from the utility perspective. I think the capital markets are not quite where the utilities are right now. I think the capital markets are more focused on generating infrastructure for the conversion of vehicles and the conversion for corporate America. That's where the capital seems to be flowing right now. I do expect that to migrate over the next 6 to 24 months to the utility side.
Gotcha. All right. Let me go, talk about some of the drivers here. I think, a lot of utilities may not have just said, okay, we want to put a lot of renewables online without RPS in place. I think that's pretty clear. So the renewable portfolio standards clearly in the U.S. have been a significant driver for ensuring renewables' role at the table. At the same time, now costs are coming down, so that's good. I guess I want to ask two questions here on RPS because they have been so successful, and now around 29 states and D.C. have them. So the first question is there any possibility we'd see a national level RPS that's been floated before? We talked about it in our book, Clean Tech Nation. It's obviously a long shot, but I'd love just the panel's thoughts on a national level RPS. Could we see anything like that? And then on the other part of that is obviously the states have been in a leadership role. There have been attacks at the RPS level from groups like ALEC. I'm sure you also saw that in Arizona, actually, it's not going to be overturned. The RPS will stay in place. But really, a little bit about the role of states and what we might see there over the next few years. So hoping to open that up to anyone on the panel, but just this role of RPS, could we see a national one? And then, are they going to continue to be under attack at the state level? So I'll hand it over to you guys.
Well, this is Don. I'll jump in. I think the prospects for a national RPS are minimal. We took a run. I chaired OEA back in 2009 when we thought we had a real prospect for a national RPS, and I don't see the politics of it lining up particularly well. And one of the problems we had, in addition to we got swept up in the climate legislation, was regional differences. If you're ever going to have a national policy that directs the portfolio mix in some fashion, whether it's an RPS or some other way, you have to take account for regional differences. The fact that the Pacific Northwest already has a ton of hydro, the fact that the Southeast has very few resources, the fact that the Upper Midwest is the Saudi Arabia of wind. You can't just sort of peanut butter it. So I think that maybe down the road we can get something, whether it's in the form of a national RPS, I'm pretty skeptical, but maybe something. I do think that the issue has shifted to the states, and that whether it's defense of RPSs or the expansion of existing RPSs, or frankly simply educating state legislatures and public utility commissioners about the benefits of having some renewables in your portfolio. I think that's where the fight's going to be.
And Doug, maybe you could chime in. I mean, obviously, any type of national RPS would have to have a lot of variation in it to accommodate the differences across the country. What's your sense of the possibility we might see a national RPS, or is that really looking pretty distant?
Yeah, so I think the policy dialogue today, at least that I'm aware of, may not use the term per se RPS, but there are some derivatives of that are still very much being looked at. So the one alternative that was most recently looked at in more detail was a clean energy standard. That actually addresses both the opportunity and of natural gas and renewables in that, moving toward decarbonization. There's also a significant amount of dialogue around performance-based standards, which is another approach toward getting toward decarbonization of the power sector without necessarily bundling it within the language of a national RPS or something like that. So there's still a fairly active dialogue going on in terms of different approaches, but I don't think you'll see it emerge as an RPS per se.
Gotcha. So more along the clean energy standard, which could include lots of other resources, including natural gas.
Or other mechanisms which exist under the the current authorities of EPA, such as performance-based standards and things like that.
Yeah, makes sense. Michael, I'm going to take a question over to you. I do, if you're on a headset, maybe go to your handset. I was still having a little bit of issue hearing you, and so let me now put this over to a different tool. So RPS, obviously, in the U.S. have helped, no doubt, with the growth of renewables. When you have states like California and Oregon and Washington and elsewhere that have pretty large, particular places that have 25% by 2025 or 30% by 2020. Those types of 33% by 2020. Those types of goals. Another way that people have talked about leveling the playing field would be to take investment tools such as master limited partnerships, which have been used pretty successfully for natural gas financing. Tools like real estate investment trusts, REITs, that have been used by the real estate industry. So I'm wondering, are you tracking anything, any tools that would open up financing to renewables, and how that might affect the marketplace moving in the near to midterm, and then we'll open it up to the other panelists as well. So Michael, could we talk a little bit about some of those leveling of the playing field with new investment tools?
Sure, Ron. I think that's the way where this is going. What we see is institutional investors extremely wary of any government incentives or subsidies. I think the institutional investors believe that they've been burned over the last 3 or 4 years, and that you have to look at a deal and how it pencils out without government incentives. So I think you're on the right track. Master limited partnerships and other financial structures are going to be the mechanism that levels the playing field. And master limited partnerships, and in Canada, Canadian income trusts, are a mechanism that I think is extremely attractive in today's marketplace. Essentially, what you have happening is very, very low yields on bonds and other fixed income instruments. Master limited partnerships that trade in the public markets are generating yields of 7%, 8%. So you're finding a lot of investor interest in those types of mechanisms. And for an owner of an asset, your valuation goes up dramatically in the master limited partnership structure because there's market demand for fixed income type investors for that structure. So our view is the government incentives and subsidies are probably not going to work for financial investors, but master limited partnerships in the U.S., Canadian income trusts in Canada are the mechanism that we feel works best to level the playing field from a capital flow standpoint.
And before we go over to Doug and Don on this. I know they both wanted to chime in. The Canadian Income Trust, are you just recognizing that as a model? I'm assuming we don't have anything quite like that in the U.S., or could you just tell us a little bit about that model?
The closest analogy, Ron, would be the master limited partnerships. The difference in the Canadian Income Trust is you can put almost any asset into a Canadian Income Trust. The rules on what could go in and not go in are much looser in Canada than they are in the U.S. I think if the U.S. were to have something more akin to the Canadian Income Trust, which allowed more assets than the master limited partnership structure, it would really open up the doors for capital into the renewable energy sector.
Got it. And now I just want to check in. Doug and Don, are you both having trouble hearing Michael as well, or is it just on my end?
Yeah, no, I am as well. So
yeah, me too.
Tough one.
So Michael, what I'm going to ask you to do, because we're having obviously some kind of technical difficulty, is maybe to dial in even on your cell phone or some other way, and let's see if we can get another line connection going and then get rid of this other line, or maybe just redial in. I don't want to lose you, but I do think we need you to dial back in so we can all hear you, because what you're saying is extremely important and interesting. So Michael, could you do that?
Absolutely.
All right, thank you. And we'll have you right back.
While he does that, Ron, let me just see if I can add a couple of pieces to that. So we had convened a couple of roundtables on these issues quite a while ago that really was under the leadership of the director of finance, Richard Kaufman, when he was at DOE, and really started, I think, a dialogue about asking the question, how do you open up these essentially what looks like an annuity, a very nice fixed income stream renewable energy project to a broader base of capital. And the MLP, Master Limited Partnerships, is certainly one avenue. That requires, in fact, a change in law. There is a law that's been introduced, a very short one called the Master Limited Partnership Parity Act, which is still yet to be decided upon. And then REITs, of course, require a ruling from the IRS. The other example, I think, where you're seeing this type of appetite come forward is, in fact, was one of the headlines that you put up from Mid-American, where you're seeing a company with a balance sheet be able to leverage that into a significant bond offering and put that bond offering out, to a set of more institutional investors than I'll call it broad public market investors. But those bond offerings were oversubscribed. They're substantially backed by the PPAs of the project as well as the balance sheet, and really represent, I think, a new opportunity in terms of bringing new capital into the marketplace. The other one what we're working on as well is recognizing the fact that, particularly for distributed solar and some of the smaller projects, that marketplace is very early in its stages relative to, for example, I'll call it auto loans or home loans. And there's a significant opportunity to standardize performance and reporting requirements, working with Fitch and S&P and others, and work through a whole securitization process that, again, will allow packaging of those assets, multiple projects, into securitable assets that can then be invested in.
Great. And then follow up on that, Don, did you want to?
Yeah, I guess it's actually been covered pretty well, but I would just note that, stepping back and saying what's the goal here. I mean, Mid-America has all the capital in the world to finance this stuff, and if they see an opportunity to float some bonds at an attractive rate, they're going to do that. You've had players, you had the European players in the market in the last decade, some of them able to operate completely off their balance sheet like a utility would. But most of them going to project finance. And of course, when the financial crisis happened and you lost the ability to finance tax credits, everybody needed a way to do that. and we got 1603 and those sorts of things. But I think going forward, the issue is can the renewable industry tap a cheaper source of capital and a broader source of capital? And part of that is still going to be monetizing tax credits. And of course, tax credits are non-cash. So that makes them different from gas MLPs that generate a lot of cash. And I don't know if Michael has come back on, but that's a question I would bounce to Michael is how do you deal with the lower cash flows, or in some years, not even much cash at all from a renewable project. But I'm not sure if he's back yet.
Michael, do we have you back on yet?
Yeah, I'm back on. Can you hear me better?
Yeah, you sound great.
Much better.
Okay. So that's absolutely a great point. In an MLP or Canadian income trust structure, you have to have assets that are cash flow generating and have some predictability of future cash flows. Absolutely. So you're probably looking to put multiple assets together to get those desired cash flows and a certain predictability around the cash flows.
Got it. And so I think this is going to be interesting to watch. As Doug mentioned, there's the MLP Parity Act. I believe that was Durgan, but I can't remember. But the MLP Parity Act, you can look at that. And then, that would take an act of Congress for the MLP piece. And then for the real estate investment trust, as was pointed out, that would take an IRS rule changing. So I think we should all be tracking that, and it'll be interesting to see where it goes. Before when we're planning for this, and questions are starting to come in right now from the audience, so please keep those coming in. One of the questions that we were talking about, and I'm going to tie this into a question from the audience, right now natural gas is historically inexpensive. It's 4 to 5 times more expensive abroad. It's very low cost here. But even in that environment, we said there can be bottlenecks on the transportation side. And so we've seen spikes on the East Coast right now for spot prices. This spot, you didn't have a long-term contract, where prices went up tenfold. So I guess two parts to this. One is, how can renewables act as a price stability hedge for natural gas? So let's start with that, and then I'll have a question from the audience. But really, let's look at the price dynamics here. Are we in for a really long-term, low-cost natural gas pricing, which may be the case, or is there a bit of volatility inherent in a fossil fuel commodity that means that we need to hedge our bet a bit with renewables? So, Don, why don't we start with you, and then we'll go from there.
Yeah, and I'm, I've been around the gas business most of my career. I am certainly not a geologist
Sure.
or from the production side. But my sense of this is we have to recognize there's been a massive paradigm shift on the natural gas side. It's just it's just a whole different technology that allows for the extraction of large quantities of natural gas at low cost. And yes, there are going to be places where we see, probably mostly because of distance and transportation and logistics issues, you're going to see some price volatility, and that enhances the value of wind and solar, I think, in that case. But I think overall, my sense is prices are going to stay low. Now, what does low mean? I mean, to me, low means no higher than $6 an MMBTU. We're certainly not going back to the situation we were in 2000. I think it was 5, 6 in that era, maybe 7, where we saw prices spiking up over $10. So it's a big change. Having said that, I think if we start to see prices inch up towards $5 and $6, renewables become much more cost effective, and I think you'll start to see you see much more price parity. And of course, I have to say, there is price parity in certain places. Some places where it's extraordinarily cheap to build and install, particularly wind, you're pretty close to parity now. So I mean, I think shale gas has changed the environment. For the long term, I think we're going to have, for at least the rest of my career, we're going to have low gas prices.
Doug, do you want to chime in on that? I know we talked about it a little
Sure.
bit.
Yeah, I'm happy to, and in basic agreement with what Don just said, but let me add a couple of points. So, projections going out are just what they are. I mean, they're the best indicator that we have. The NYMEX strip today, already indicates that future gas prices are going to trend upward, north toward $5-6 at least by 2020. But that's an unknown going forward. The fairway of where gas prices are, I think, is determined by the dynamics of the industry, including what's going on in the shale development, but also the oil-rich shale developments, and really where they're going to be able to gain profit out of those exploration and production processes. On the flip side, the only other piece I'd add is that there's definitely an opportunity for renewables in the distribution edge, where you see significant cost competitiveness, again, regionally dependent, depending upon the retail electricity prices. So folks in California that are facing 20, 30, and 40 cent per kilowatt hour peak prices or daytime prices certainly have a very different value proposition than those that are in the southeast.
Michael, let's get your take on this too. Where do you see natural gas pricing going? And one question that just came up, so maybe you could add to this, is that if exports start to pick up, maybe you could talk about that. But if exports pick up, what will that do to pricing as well for natural gas in this country? So handing that over to you, Michael.
Sure, Ron. What we're seeing from investors is less money now going into exploration and production because prices are so low, and money flowing to build out the demand-side infrastructure, the conversion of vehicles and industrial users to natural gas. So I think at the present time, that's where the capital is going, to stimulate the demand side. And that should, I think, serve to push up the prices a little bit. I do think, though, that as prices go up, you'll see more capital again flow into exploration and production. I think the big unknown is the export markets. I think you talk to a lot of people in the industry, and there's a lot of folks who believe that the government will not allow a lot of export of natural gas. It'd be more effective from an economic standpoint in our best interest, not to the gas producers, but to the economy, to allow U.S. industry to become very, very competitive with low energy prices. So I think there's an expectation among financial investors that you're going to have low prices for a while, and that the export market is not going to help on the demand side.
Great. All right. So I want to move now over to some of the issues with natural gas that the environmental community has been talking about. And I mentioned methane leakage. It's become a big issue around natural gas production, transport, and distribution. And some of the modeling, if it holds true, means that natural gas could be a much larger contributor to CO2 emissions than earlier suspected. I'm going to give this to Doug first, because I know you guys have done research on this. What do you think of that research, and do we have cause for concern here as sort of an unknown piece right now about how much natural gas may be contributing to overall methane leakage?
Yeah, thanks, Ron. In fact, we did publish a relatively detailed report last fall on this that had a significant section on greenhouse gas emissions for shale gas relative to other generation technologies for electric power. And in that analysis, we actually did two things, and I'll share with you kind of the summary of that. The first is that you have to look across the whole suite of the analyses that have been published to date, and from a life cycle assessment, you have to put those on I'll call it an apples-to-apples comparison. When you do that, the dispersion, the range of those estimates reduces fairly significantly, and you can see where the sensitive assumptions are. That analysis, as we did it, and then complemented it with the first real bottoms-up analysis of shale production, where we looked at over 16,000 point sources from the Barnett in 1 year, really indicates that shale gas is approximately comparable to conventional gas. again, from a limited data set. Now, I'll caveat that very carefully, is that we really don't have a significant amount of good, robust data and analysis from good data. There's some other activities underway. There's a new inventory by EPA going forward, et cetera. So I think the indications are it's about 50% of coal. But I'll hold judgment on this until we get much deeper technical data and validated data.
And until we have that data, would there any reason to take pause and slow down at all, or what's your take on that?
I don't think so. I think, where we're seeing economic benefit, we're also seeing greenhouse gas reduction benefit. So one has to realize that the fugitive emissions are a very small part of the overall emissions when you look at natural gas and or coal or other fossil resources for power gen. So for example, fugitives might be 1 to 3 to 5% of the total emissions profile, and really the bulk of it comes from the combustion burner, at the tip. So we do see net positive benefits right now, with the positive displacement of coal. But what we don't know is really what are the impacts over the long term. And so we need to, just need to learn more.
And I think we had talked about this before. I mean, obviously there's been a significant reduction in the U.S. As we've been taking coal offline and not adding new coal, and I think that's one of the reasons is exactly what we're seeing with, natural gas and renewables being the main new capacity additions. I want to talk about one other thing that could be a sort of really change the game, could be very problematic for natural gas. Just very quickly, from anyone on the panel, if anyone wants to take it, a number of states have been very concerned about hydraulic fracturing within their communities. They've had moratoriums. Could we be a fracking accident away from significantly spiked natural gas prices and really having to reconsider this, or are those concerns overblown? Maybe Don first and then Michael?
Yeah, thanks, Ron. I think that I think every technology has, that black swan risk of a real sort of blowout environmental disaster. I mean, if you kill one condor in Southern California, and the wind industry has a real problem, for example. I think a lot was made several years ago about the fact that there were a number of exemptions created for the fracking industry back in, I think, 2006, 2007 during the Bush administration. What I've seen is the industry get ahead of a lot of that and improve. And again, I'm no expert, but what I hear from the experts is they're getting better and better about how they develop, fracking properties. You also see the bigger, frankly, more responsible players getting into the space. So the Shells and the BPs and so on, who take their environmental record pretty seriously. The one area where I just see, I just wonder if we know enough is, you also have to transport natural gas. And sometimes it gets transported very long distances, and sometimes in older pipelines, and we do know there are losses. And I know this is being studied and by people who are smarter than me, but there's something in the back of my mind nagging that the methane losses and the transportation and distribution of natural gas, could be an issue in the future when we have better data.
Yeah, and so Michael, I know you're doing more natural gas. I'm just wondering, one of the questions that just came up, which totally echoes what I just asked, was, some people maybe try to say, look, it's just some radical enviros who are complaining about this, but we hear from people on the ground that are concerned about some of these issues. Clearly who live on farms or nearby fracking. Is your sense that the natural gas industry is starting to take this a little bit more seriously, and that we're seeing more regulation and policy and self-governance in place, or is it still a wildcat mentality out there? I'm just wondering if you could address that quickly.
Yeah, I think companies are handling it more responsibly. What I am seeing, Ron, is I'm not seeing investors price in a risk premium because of the risk of an environmental issue into their pricing of the assets. So the market is saying, the institutional market is saying, we don't see undue risk, undue environmental risk. The one area that we haven't talked about that I think is very important is the water, the cleanup of the water using fracking. And what we're seeing there is really amazing. We are seeing new technologies and new companies that treat and clean water used in fracking growing very, very, very rapidly, and capital coming into that sector. To me, that's one of the new tertiary industries that's developing because of the fracking. The ability to effectively and cost efficiently clean that water. We have seen numerous companies receive capital to enter that sector.
Ron, if I may just add a couple of points. There were two pretty landmark reports done at a national level. The first was the Secretary's Energy Advisory Board, and the other was the National Petroleum Council North American Resource Development report that covered a number of these issues now about a year ago. And I would concur. I think that there are multiple different aspects going on, both the improving their management practices. In particular, for example, in Pennsylvania, you're seeing over 90% water cleanup and recycling use, and that's different depending on different basins. There are also the development of more regulations, mostly at the state level, but certainly discussions at the federal level. And I think most importantly, where the risks lie are in what we call the social license to operate issues. So it's a new paradigm where the development of natural gas is in much closer proximity to neighborhoods and farms, et cetera, and it's really a new way of doing business, of engaging with the local residents. It's not saying it's not being addressed. And there are a lot of industry-led activities in terms of frac focus, and so that's the disclosure of fracking fluids. And the other thing that I think comes out of those two reports is that it's not fracturing per se, which is at question. It's really the practices around well completion, baseline monitoring, and post-monitoring, et cetera, which are really much more important than the actual operation of hydrofracking.
Great. Let's move on to another question from the audience that sort of follows up a little bit on this, the general topic. Obviously, all energy sources have their black swans. Don, you said that, I believe. And I think the question from the audience member is, the President has called for an all-of-the-above energy approach in the U.S., but looking at the U.S. assets right now, we're in a pretty unique position, and we can make choices. We could choose perhaps next-generation nuclear, but not current-generation nuclear. We can choose not to have coal. And really, if you look at the U.S., and we outline this in our book, you really could build an energy future in the U.S. off of natural gas, renewables, and, of course, which we haven't even talked about yet today too much other than smart grid, is efficiency. And as we know, in places like Oregon, where I happen to be, our new energy, our 10-year energy plan really is looking almost entirely at efficiency. So is the U.S. in a unique position, and should we make choices? Don, why don't we go to you first, and then we'll go around the table, and then we'll have one more question. We'll have to wrap up soon because we're near the end.
Yeah, I think it's pretty commonly believed that efficiency is the low-hanging fruit. There's a couple of issues. One is just the regulatory incentives and how you go and create the incentives, or at least remove the barriers to doing energy efficiency. I mean, if you do an energy efficiency on a utility system, there's a loss of revenue, and there's some older sort of ways, decoupling and so on, to deal with that. But it's a lot of utility commissions don't like that. So I think the other big barrier is, frankly, the grid and information. We could enable a ton of energy efficiency with some of the smart grid, and smart grid gets thrown around. What I'm talking about is grid-level information that allows for everything from manipulation of appliances to interconnection or interfacing with industrial processes. To allow for efficiency, as well as providing information back to the consumer that allows them to make economic choices. So I think those things are really important. And you also, in addition to smart grid, you have to have the market structures to do this. And we've seen market liberalization in the form of independent system operators and the development of some of these ancillary services markets. That's where you get the price transparency and the ability to react in real time in very short-term markets. Interestingly, that's really an important component to enabling more renewable penetration as well. The ability to price competitively, that flexibility that you get from a gas plant, or conversely, to price the variability that you get from demand or variable resources is really important to enable this entire clean energy strategy.
Great. Michael, what's your sense? Can we make a choice here in the United States? We're blessed with abundant natural gas, abundant renewables. We have the know-how to probably overcome some of these bottlenecks with advanced demand-side management technologies, energy storage, et cetera. Are we in an enviable position? Should we make some choices here?
Yeah, I think Ron, I think we're absolutely in an enviable position, and we have a high-class problem. Right, we can be energy self-sufficient here in less than a decade. I think what it's going to require, though, is really a national energy policy. I mean, at a strategic level, we need to develop a plan, develop priorities, develop incentives to the markets around those priorities. It's it's time to have a national energy policy that will give guidance to energy users, energy producers, and the financial markets.
And Michael, is there, this was a question from the audience as well. I just try to get it in, and we'll go to Doug before we wrap up. Is there a specific policy or tool that they want to ask the panelists, a specific policy or tool that would help ensure the growth of the resources we've been talking about today? Is there anything in particular, a carbon tax? Now, you tell me, is there something that you would call for that you think would help drive the market?
Yeah, I'm a little leery of a carbon tax. I think you have to have a level playing field, and there are still a lot of built-in incentives to the oil and gas industry. I think those need to go away, for one.
Or open them up to the renewable side. Would that be right, as we talked about earlier?
Yeah, that'd be the other option too.
Okay. So, Doug, let's wrap up. Are we in a special position here, and what do you think of making choices rather than an all-of-the-above energy approach? And then finally, any policy toolkit recommendation you might have?
Yeah, we are in a unique position. As you said, abundant natural gas resources, abundant renewable resources, both markets very healthy, as you talked about in your introductory slide. I think it's a unique time to continue to invest in technology innovation on the smart grid, into additional clean energy technologies, and to really take advantage of that for our own economic development, as well as our energy security and the environment going forward. In terms of policy frameworks, I think we're going to continue to see portfolio approaches, continue to invest in R&D. You're going to see activities in the states. And at a federal level, again, depending upon how Congress plays out, you'll either see new legislation or you'll see, some movement on existing authorities underneath the Clean Air Act and other authorities that are already in place. So I think it's very positive. I think, one of the key things that we need to keep in mind is there's a lot of near-term opportunity, but we also need to keep our vision on the medium and the long term. Kind of where are we going? Everyone talks about bridges toward the future. The question is of course, defining, what that future looks like and making sure you're building the bridge in the right direction.
Excellent. Well, Doug, Michael, and Don, I want to thank you for your time today. I hope our conversation was as interesting to the audience and helpful and informative as it was for me. I look forward to continuing the dialogue. I want to also thank once again our co-host, Cascadia Capital, for making this webinar possible, and to our other series sponsor, Autodesk. Please note, everyone, that this webinar has been recorded, and our plan is to post a link on our website later today or tomorrow. And be on the lookout for our next webinar on 3D printing meets sustainability. Thanks again to all of you and to our panelists. Have a great day.